Today, folks, I want to do some direct comparables between one of my favorite ETFs of all time for dividend income being SCHD versus VOO that represents the S&P 500. We'll look at some 5-year performance charts. I want to talk about the long-term dividend growth rate, and we'll take a look at the top 10 holdings of SCHD to see what ones have actually outperformed the S&P 500. Now, I'm going to first and foremost focus on it from a Canadian investing perspective. So if you do want to just focus on the SCHD comparables to VOO, you can skip to the time code in this video if you're more of a US investor and you don't care as much about Canadian focused content. But first and foremost, as many of you know, I was very fortunate in my registered retirement savings plan to take some really awesome capital gains from Tesla, liquidating it between 2021 and 2022. And I took all of those funds to core focus, basically a long-term dividend income strategy with SCHD, at which I put all those funds in there. Now, the registered retirement savings plan does come with some caveats. First and foremost, you have to liquidate this fund by the age of 71, at which any funds you pull out of this account, you will get taxed at your nominal income bracket. So it's better to pull funds out of this when you're basically not making as much into your retirement, or you're in a lower income bracket, or you can defer it a bit by putting it into a registered retirement income fund at 71, which is basically a new retirement fund that forces you to draw the money out year over year, but at a more slower pace, extending, paying taxes on it for just a bit longer. However, I plan on drawing these funds out from the dividend standpoint much sooner. Now, the other bonus from this, first and foremost, is as Canadians, we get hit with a 15% over the border withholding tax. Same if you're a US citizen buying Canadian dividend stocks. But the Canadian government said, hey, you know what? We're going to give you a bit of a benefit here, and we're going to waive the 15% withholding by owning this in this tax sheltered account. Now, I do have plans to draw against this account earlier on, long before I hit 71 years old, but the goal is maybe in my 40s or 50s. I'm not exactly sure when, but I will just purely start pulling out the dividend income and basically just pay the regular tax and use it to basically pay my bills. And then eventually, maybe if I make it to 71 years old, I can defer this to an RIF at which I can start drawing from the capital gains, depending on the value of this ETF at that point in my life. But the whole goal here is to start perpetuating, passive income without touching the initial investments for as long as humanly possible. So let's do some direct comparables here. Let's talk about the Schwab US Dividend Equity ETF performance, and we'll start with the 5-year, because compared to VOO on the 5-year, it's almost directly in line when you take into consideration the dividend income. And when we talk about performance from top to bottom here, from the peak of 2022, it's only down about 9%, whereas VOO is only just started the pullback, but it's down about 5.91%. In the last 5 years, both of these have been very, very comparable in their performance. Now, unfortunately, SCHD is a relatively new ETF, and the performance only goes back to about October 21st of 2011. So if we go back to 2011 and we scale that line out, we can see the S&P 500 is up about 262%. Over that decade period, you've been collecting probably about 1 to 2% in a dividend. So you can tap on probably another 15 to 20%, give or take, which would take you probably to about 280% total returns not reinvested. SCHD is up about 191%, but getting a 3.5% dividend. And again, we're not talking about the dividend increases, but we will in a moment. I mean, that takes it up closer to probably about 220 to 230. Again, not reinvested, not talking about dividend growth. So for a 1-to-1 from a return standpoint, obviously the S&P 500 has yielded much greater results, but there's a lot of concern people have right now that the S&P 500 is largely overvalued thanks to its top tech companies making up the vast majority of the ETF at this point. And this is why I love owning both of these ETFs, because one, I use as a primary hedge against in case the S&P decides to start flatlining or downtrending because it is overvalued, because SCHD, when we look at the valuation metrics, is trading way below on the price to earnings multiple, but the dividend is what I care most about. I think SCHD still has some real capability to outperform the S&P 500 just from dividend growth alone, because what we have to take into consideration is SCHD was paying 12 cents pretty much on an inception in 2011, and today a quarter is paying 66 cents. It's like well over tripling, quadrupling of the dividend. But if we take a look at the actual dividend growth rate, it sits on a 5-year at about 13.92%. That is absolutely incredible. Whereas VOO over the last decade, we can see here going from 67 cents a quarter to $1.58 is just over doubling, and that compounded 5-year growth rate is reduced pretty greatly because it's become more, tech growth oriented. Has only been 6.16%. So you can see that you're actually getting over double the dividend growth with SCHD than you are with VOO, especially over the last 5 years. And again, if you're a dividend or income oriented investor, I think SCHD could be an end all be all for dividend ETFs. Now, there are some other great ones out there that we have talked about in the past, but this is just my personal favorite. So let's get into some of the actual value metrics here. Firstly, the expense ratio is excessively low compared to a lot of dividend ETFs that do exist. And considering that the PE multiple on this, according to the just the fund characteristics on the Schwab US Dividend Equity ETF profile, it sits right now at about 13.87, which sits dramatically lower than the current price to earnings multiple in the S&P 500. That's 25.5 in this current macro environment. But continuing to take a look at some of the structure of this ETF, I want to break down primarily just the top 10 holdings, even though I think beyond the top 10 there are some great stocks in here, but I think these top 10 make up just over 40 to 50% of the entire ETF. We can see most of it is primarily in industrials, healthcare, financials, and consumer staples, and then information and technology, and then the rest of them making up some smaller percentages in the sector allocation. So let's break down these top 10 holdings just to see the comparable performance over the last 5 years, to see how many of them have actually outpaced the S&P 500. But I should note too, the SEC 30-day yield is sitting at 3.58%. So even when you wipe out the expense ratio, which is excessively low, I mean, you're talking about a dividend yield still over 3.5. So let's just take a look at, first and foremost, the top one here being Amgen, which over the last 5 years has not kept up with the performance of, let's use VOO again as the example. We'll use this as a baseline, which is up 56.8%. And if you tap on the dividend, closer to 60%, but still up 32.39%. And even with a 3% dividend yield, it is lacklustering the pace, not by much though, because again, if you tap on, over 5 years, 3%, it's an extra 15%, taking it up to about 45% not reinvested, still pretty close to the S&P 500's performance. AbbVie has been actually outpacing the S&P 500, up almost 54%, with a 3.89% dividend yield. You tap that on over 5 years, definitely outpacing the S&P. You got Home Depot here, which has earnings coming out actually tomorrow, I do believe, but taking a look, up 68%, excluding the dividend, which is over, well, pretty much up an extra percent over the S&P 500's currently, I think 1.5 or under 1.5% yield. You have Cisco here. This one's only up 17.2%, dramatically underperforming the S&P 500, even with its just under 3% dividend yield. Broadcom absolutely crushing it here, up 303% with a 2% starting yield here. So this one's been a huge outlier. UPS with its again, really high almost 7% yield, has been outpacing the S&P 500 with that, trading up 44% over the last 5 years. We've got Chevron, a new Warren Buffett favorite, maybe. He did sell almost 20% of the position here in the recent filings, but this one's up 39%, but with a 3.7% yield, is actually coming closer in line with the S&P 500's performance. And then some of my favorites being PepsiCo, of course, here, definitely outpacing the S&P 500 by leaps and bounds, and of course, Coca-Cola, another Warren Buffett favorite that has actually been kind of underperforming the S&P 500 slightly. It's only up 30%, excluding the 3% dividend yield. And then finally, Merck & Company, this one crushing it, up 65.44% with a 2.68% dividend yield. So all in all, if we take a look at some of the other holdings and we go view all, as we scroll down, I do actually love some of the value plays that I believe exist in this ETF. Because we go a little farther, we got Verizon Communications making up 3.63%. I do believe that to be a value player along with Pfizer. So it's nice to see this exposure to these healthcare companies. You have things like BlackRock, Lockheed Martin. If you are a true dividend lover, you can't really go wrong with MO, and I think it is more appropriately weighted in this ETF by kind of just cutting it in half compared to some of the top weighted holdings. 3M's in here that could be discovered as a value player. We got some of the U.S. Bank Corp, some of these regional banks that, even though we've seen Warren Buffett selling them, some of the guys from the 2008 financial crisis like Michael Burry has actually been more favored toward them. You've got Ford Motors in here. There's just a lot of incredible companies that exist within this ETF that make me love it from a diversification standpoint, just from buying one simple ETF. And the dividend community is largely picking up on that, buying into it as well. But this will be one that I cost average into in perpetuity for the rest of my life. But it isn't the end all be all, as I do believe growth should be a good proponent of everyone's portfolio, which is why I do consider buying the S&P 500 and cost averaging pretty much 50-50 between these two ETFs as it stands in this current moment. But I'd love to know what you think about SCHD in that comment section below.